Asian shares firmed as investors braced for a busy run of inflation data that could set the scene for a European rate cut as soon as next week, and a U.S. policy easing within just a few months. UK markets are closed for the late May bank holiday, while stateside U.S. markets are shut for Memorial Day. Locally, Tiger Brands reported an 11% rise in half-year profit as the food producer hiked prices to recover higher input costs, although that dampened volume growth as customers reined in spending. Pick n Pay, on the other hand, swung to a full-year loss as the grocer took an impairment of 2.8 billion rand on loss-making and underperforming core stores. The Ackerman family is stepping aside as the majority shareholder of Pick n Pay stores amid a revamp of SA's third-largest grocer by revenue. The move comes as Gareth Ackerman also said he will retire as the chairman as the company focuses on a new 6-point strategy to restore the core Pick n Pay supermarket business to profitability. To give us more perspective on the markets, we are joined by Gary Boyson, who is from Rand Swiss. Gary, thank you so much for your time. Your assessment of the Rand as well as our local markets as we get closer and closer to election day.
I think the Rand has been surprisingly strong leading into these elections. We're currently trading just a touch under 18.40 to the US dollar. Some of that is probably dollar strength, but you can't argue with the fact that we haven't had load shedding for a couple of months. This is feeding into expectations around what economic output in South Africa will be like. And I think there's definitely an optimism around the elections. That said, there are just so many permutations. We've been sitting in the office throwing around all the different scenarios that could result from Wednesday's election, and there's a lot of uncertainty. I think this is one of the elections with the most uncertain outcome that we've seen in a long time, and that itself creates risk and that creates volatility. So I would expect probably a large move in the currency in the days and weeks to follow the national elections. So a lot to play for. I think a lot of people sitting on the sidelines waiting to see what happens with the elections before committing capital.
Let's talk results for a bit and start off with Pick n Pay, which I thought was probably the biggest news item, at least for me. They took an impairment charge, which I mentioned, of 2.8 billion rand. They're also saying that they're underperforming and loss-making stores. 100 of those will either be closed or converted. What do you make of Pick n Pay's results, and also, I suppose, the news as it relates to the Ackerman family?
Yeah, so I think finally we're getting decisions from Pick n Pay that the market has been looking for a long time. And that's a real shake-up, a real change at Pick n Pay, because for years we've been promised that the turnaround is around the corner, but it never quite happens. So obviously, with the Ackerman family taking a more of a back seat, they're dropping board seats. They will still be following their rights, the rights offer. Pick n Pay obviously raising 4 billion, recapitalizing, and really trying to get its strategy back on track. I think very optimistic, and you can understand why the stock is up 6.25% at the moment. So the market definitely liking what they're seeing, even though we did see a decline of 87% in full year trading profit. Now, we did know a lot of what was going to come out because there was a sales update on the 22nd of May. But obviously, the market looking forward, looking through this and saying, is this the time that Pick n Pay really manages to turn around? Other parts of the strategy that were announced today, the QualiSave brand that was only recently launched will be moving back to the Pick n Pay brand, for example. Yes, they're going to shut a lot of those stores, but and they've announced that they expect volume decline. But this level of I suppose change at the company is definitely needed, and that's why I think the market is reacting positively to what was a fairly weak set of results.
When you look at Tiger Brands, was there anything that caught your attention there?
Also, just how difficult the operating environment is at the moment. So Tiger Brands obviously very well run. The stock's down around 1% on the announcement. Headline earnings up 11%. They've increased their dividend by around 9% to 3.50 per share. Yeah, but very, very difficult. It's also a company going through a leadership change. So Chart Kruger, the new CEO, has now put together his management team. But really, just painting a picture of how difficult it is out there. So 8% inflation in their numbers. So putting up prices aggressively, resulting in a 1% revenue decline, and that just tells you the story on volumes. Volumes down around 9%. So a very, very difficult environment, but Tiger Brands doing what Tiger Brands does. It's protecting the brand, and it's trying to maintain those margins and accepting the volume declines on the back of it.
The last time you and I spoke, we spoke a little bit about what was going on in the commodity space. When you look at some of the movements we've seen, if you were interested in the commodity market, where would you want to be?
I think where you want to be in the commodity market at the moment. I mean, we've talked about an exit from platinum, almost long term. I can't see where the demand for autocatalytic converters can be replaced. But I kind of almost go along the lines with BHP here, and I think copper is one of the more exciting commodities. They call it Dr. Copper, the metal with a PhD in economics, and with the rollout of AI and robotics and really the development of so many of these systems, that copper is going to be required, and we can see it in a transaction that the proposed transaction between BHP and Anglo. What does BHP want? They want those copper mines in Peru and Chile. It really is, I think, the metal that you want to hold for the next 5 years. It's the kind of metal you want your commodity miners to be exposed to as well. So if you're optimistic on global growth, and I think I am, copper is what you should be holding.
Well, that's it. As we wrap up, have you made any major portfolio changes year to date?
Not again. We have a fairly long-term strategy. We run a thematic approach, over and above our standard international share portfolio. And the changes that we've been making there is we've actually gone slightly underweight on smaller tech, and we've been maintaining our exposure to the big tech. A lot of people say it's too expensive. It's been expensive for a long time. It still seems to be working for us. And what we've changed are some of the smaller tech exposure into actually pharmaceutical companies. So we see a lot of advances coming in new drugs, specifically, the relation between some of the companies that we're holding in Isomorphic Labs, which is a Google AI company. I think that's pretty exciting. Also, I think the big tech is insulated to an extent, and the smaller companies are not getting their exits like they used to. Antitrust regulation is getting more and more stringent in the US. People like Lena Khan, at the FTC, refusing to allow some of these big transactions that the smaller tech companies really need in order to roll out their products. And with that in mind, you kind of stick big tech and you explore big pharma, and that's where we're going.
All right, Gary, thank you so much for your time. That is Gary Boyson, who is from Rand Swiss. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.